Welcome to Dr. Fred Markets. This is not financial advice. While most people ignore what's happening in the markets, a few choose to pay attention. And that difference, that simple choice to stay informed, changes everything. You're one of them. Let's get into it.
Dividend investors are quietly funding the next energy drink bubble. Let's start with the numbers nobody on CNBC wants to say out loud. Monster Beverage is up over 90,000% since the 90s. Celsius ran over 5,000% in 5 years. Meanwhile, the S&P 500 dividend yield today limps at about 1.3%, and the index just bled over 2.5% in a day. That safe income machine is acting like a tech stock with high blood pressure and no upside flavor. Signal 1. Energy drinks are now a macro asset class dressed as soda. Monster does over $7 billion in annual revenue with net margins north of 20%. Celsius revenue exploded from under $100 million in 2019 to over $0.5 billion now, hijacking shelf space from Coke and Pepsi, like a hostile takeover in a grocery aisle. This is not beverage. This is leveraged human attention sold in cans at $3 a hit. Signal 2. Crude oil stocks are starving while your fridge is full of liquid electricity. America's crude inventories are perilously low, so the grown-ups are panicking about barrels. But your real daily dependency is not oil, it's caffeine and sugar. Every bull market, we invent a new stimulant to work longer, scroll harder, trade dumber. Red Bull, Monster, Celsius, crypto bull runs. Same cycle, more leverage, more screens, more caffeine. Signal 3. The market today punished Nvidia harder than your heart punishes your third energy drink. Nvidia down over 6%, S&P down, but Bitcoin is green, Ethereum is green. Risk isn't dead, it just moved couches. Capital is sliding from mega-cap AI hype to edges of the casino. Volatile crypto, weird small caps, and boring niche monopolies like energy drink kings. Everyone screams AI crash but forgets the timeless trade. Sell the shovel, buy the pickaxe dealer. In 2024, the pickaxe is caffeine in a can. Here's the cliffhanger. Income investors still cling to 3% yields while ignoring the fact that energy drink stocks quietly behave like leveraged lifestyle ETFs on human burnout. Now the connection. You don't invest in energy drinks, you invest in the system that needs them. Low crude inventories tell you this. The world runs hot. Energy is tight. Workdays are longer. Remote work blurred the line between off and on, and gambling on screens is a full-time job. People are trading options at midnight, doom scrolling at 3 a.m., running side hustles on fumes. Energy drinks monetize that exhaustion. Dividends sugarcoat it. Dividend investing says, own stable companies that pay you to wait. Energy drink investing says, own the drugs that keep the system going.
Does what you just heard make you want to learn more, to dig deeper, to ask better questions? That curiosity is exactly what separates people who understand finance from those who don't. Most people stop at the surface. You're going further. Let's continue.
Monster never paid a dividend. Instead, it reinvested, compounded, and quietly turned early holders into monsters themselves. Celsius is repeating the pattern, leaning into insane growth, distribution deals, and flavor of the month branding. Meanwhile, blue-chip dividend aristocrats barely outrun inflation, and their safety depends on a workforce that now lives on 200 milligrams of caffeine per can. Here's the mechanism. 1. Human burnout rises. 2. Energy drink consumption rises with it. 3. The companies selling burnout fuel gain pricing power and brand addiction. 4. Meanwhile, dividend investors emotionally anchor to quarterly checks and ignore total return math. Your safe 4% yield stock gives you $4 a year on $100. Monster turned $1,000 into a house. That's not risk-free, but it's brutal math. So what do you actually do with this? This is not financial advice, but here's the truth. First, stop worshiping dividends like religion. Income is fine, but cash flow from capital gains is still cash flow. Look at total return over 5 to 10 years, not just the coupon your broker pats you on the head with. Second, study vice-adjacent growth. Companies that profit from habits the system refuses to fix. Energy drinks are one. Others exist, but this one is clean, legal, insanely scalable, and hiding in plain sight in your fridge. Ask, does this product benefit when people are tired, broke, stressed, and online 12 hours a day? If yes, that's the new dividend. It pays you back in stock performance, not quarterly crumbs. Third, build a barbell. On one side, your boring, low-fee index or dividend ETF, the ballast. On the other, a small intentional slice of high-conviction burnout beneficiaries like energy drink leaders. Size them so a crash hurts your ego, not your life. The lesson today: dividends are not safety, they're a story. The real trade is owning the businesses that tax human burnout the way the government taxes your paycheck. You learned one thing today: energy drink stocks are a leveraged bet on the world staying exhausted. You saw the mechanism. More burnout, more cans, more pricing power, more compounding. Your action: audit your portfolio for fake safety, then spend 1 hour reading the 10-year charts and financials of Monster and Celsius. Decide if you want to be the customer or the landlord of the fridge. Subscribe if you're tired of bedtime stories about safe yields and want the ugly math instead. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's it for today on Dr. Fred Markets. I hope this gave you clarity and a new perspective. Remember, this is not financial advice. Always do your own research. If you found this useful, subscribe. It's free and it helps the channel grow. Find me on the blog at drfredmarkets.com and join the newsletter via the link in bio. I'm Dr. Fred Markets. See you in the next one.